Well, firstly, may I wish you a very good morning and welcome you to the Shropshire County Pension Fund Annual Meeting 2017. My name is Tom Biggins. I'm a councillor for Whitchurch North and I'm chair of the Pensions Committee. We have 4 very interesting presentations lined up this morning. Firstly, we will hear from Justin Bridges, the Head of Treasury and Pensions, who will provide us with an update on the investment performance of the fund over the last 12 months. After Justin, we have Daniel Nicholas from Harris Associates, and Harris Associates are one of the pension fund's managers, and Daniel will be talking to us about global equities. Then we will have Jason Fletcher, who is the recently appointed Chief Investment Officer of LGPS Central. And Jason will give us an update on the LGPS pooling project. Then to close the presentations, at the far end of the table we have Debbie Sharp, the Pensions Administration Manager, to provide an administration update on the work of the pensions team over the last 12 months and to also look at any upcoming issues that may occur in the future as a result of LGPS. As usual, we haven't issued individual copies of the slides this year, but some large print copies are available on request. And alternatively, you will find all these available on the pensions website after the meeting. And also very excitingly, this meeting is being filmed, and that also will be on the website. After the presentation, there will be opportunity to ask questions, but there are also members of the pensions team present who will be available so that if you have any more personal queries that you may wish to take up with them on an individual basis. So without further ado, I'd now like to hand over to our first presenter, Justin Bridges.
Well, good morning everybody. I'm Justin Bridges. I'm the Head of Treasury and Pensions here at Shropshire Council. And my presentation today will give you an update on the pension fund's investments over the last 12 months and how the fund's managers have performed. I will also update you on the changes made within the fund and the issues the funds will be addressing over the next 6 to 12 months. This first slide just gives a general overview of the Shropshire County Pension Fund. The value of the pension fund as at the 31st of March 2017 was just below 1.77 billion. As at November, it is now close to 1.87 billion, which is its highest level. Membership of the fund now stands at over 46,700, an increase of 1,200 from the previous year. The total number of employers within the fund has also increased to 164 over the last 12 months. Shropshire Council and Telford and Regional Council are the 2 largest employers within the fund and represent 75%. The main reason for the increase over the last year was due to more schools converting to academy status. This chart details where the fund's assets were invested as at the 31st of March 2017. How the assets are split is the most important decision the pension committee makes, as this has the biggest impact on how the value of the fund grows over time. You can see that 52% of the fund was invested in equities, 21.5% in bonds, 3.5% in liability-driven investments, 10% in hedge funds, 5% in property, 5% in private equity and 3% in infrastructure. The Pensions Committee has overall responsibility for the asset allocation within the fund, and this is decided based on advice from the fund's investment consultants, independent advisors and officers. The asset allocation of the fund is a key driver of the investment returns. All of the fund's investments continue to be managed externally. As you can see from the chart, the fund is well diversified as not all investment types perform well at a particular time. The fund appoints specialist investment managers to invest in different asset classes for diversification purposes in order to mitigate the risk to the fund in different market conditions. Each of the managers appointed specialises in a particular asset class. Harris Associates, for instance, manage an 8% allocation in global equities. They are an unconstrained global equity manager, meaning they can invest anywhere in the world. And the portfolio is very concentrated, investing in around 40 stocks. A general overview of their investment style and their performance over the last 12 months will be covered in more detail in their presentation. Since the end of the financial year, the allocation to hedge funds has now reduced from 10% to 7.5%, following the termination of one of the fund's hedge fund managers due to a period of underperformance. We previously had 2 hedge fund managers, each managing 5% allocations each. Proceeds have now been received back in full from one of the hedge fund managers, with 2.5% being allocated to the fund's other hedge fund manager and the other 2.5% to one of the fund's bond managers. And this was approved at the recent pension committee meeting. This graph shows how the fund's portfolios have performed during 2016-17. The red bars on the graph represents the fund manager's performance, and the blue bars represent the benchmarks that managers are measured against. The Shropshire Fund had a very positive year last year. You can see that we've got the highest returns from Harris Associates, our global equity manager, rising by a notable 43% during the year. Positive returns were also experienced by the fund's other active global equity managers, increasing by over 30% during the year. The fund's UK equity manager rising by 25%, and infrastructure also increasing by over 28% during the year. As shown in the previous slide, the fund has a total allocation to equities of 52%, and equity markets had a very strong year last year, which benefited the fund overall. All of the fund's managers produced positive returns last year, and 10 out of the 14 managers delivered performance above benchmark, which is a reason for the strong outperformance during the year. This slide shows how the outperformance has impacted on the fund value over the last year. The fund increased in value by £274 million to be valued at just below 1.77 billion as at the 31st of March 2017. The value of investments increased by 19.2% during the year, and the fund outperformed its benchmark by 4.9%. Since the end of the year, the fund has continued to rise and increased by a further 100 million to be valued at 1.87 billion, which is its highest level. This bar chart highlights the longer-term performance of the fund. As mentioned in the previous slide, performance over the last 12 months was very strong. But you can see the performance of the fund over the longer term is also positive. Overall, the fund has increased on average by 10.5% per annum over the last 3 years, which is 1.6% above the benchmark. 10.9% per annum over the last 5 years, which is 2.1% above the benchmark, and 7% over the last 10 years, which is also 0.1% above the benchmark. Over the last 3 years, infrastructure earned over 26% per annum, and private equity earned over 18% per annum. And double-digit returns were also delivered by the fund's active global equity managers. Due to the recent strong performance of the fund, highlighted in the previous slides, at the June Pensions Committee, our independent consultant and investment advisor and officers discussed the strong rally in equity markets and the improvements in the funding level since the last actuarial valuation, which was undertaken in March 2016. The funding level, which is the difference between the total assets of the fund compared to the liabilities, has increased from 84% at the last valuation to almost 100%. One of the fund's long-term investment objectives is to achieve a 100% funding level. So the recent strong performance has gone a long way to help us achieve that objective. Equity risk within the fund is the main risk faced by the fund. And following a survey undertaken with the Pensions Committee early on in the year, the consensus view was if the funding level improved more than expected, then the members would be interested in exploring the options to reduce this risk within the fund. At the meeting in June, following discussions with the committee members, it was also decided to leave this equity exposure at the current level of 52%, and explore options to implement an equity protection strategy which would protect the fund if there was a sharp fall in equity markets. With this in mind, an equity protection strategy has now been implemented to protect a proportion of funds from falling equity values. Out of a total of 950 million of equities, a decision was made to protect 280 million for a period of up to 18 months from falls in equity values between 5 and 25%. This has enabled the fund to lock in the substantial gains earned from equities over the recent years. In effect, what we have done is bought an insurance policy which protects the fund against future falls in equity markets. If markets continue to rise, we will still benefit from this outperformance, as not all equities are protected. If markets fall, then we have got some protection in place. This slide provides an update of the issues the fund will be addressing over the next 6 to 12 months. Jason Fletcher, the Chief Investment Officer of LGPS Central, will provide an update a little later on the significant progress we've made over the last 12 months to set up LGPS Central, which will be a £40 billion FCA-regulated investment management company which Shropshire County Pension Fund will be part of, along with 8 other LGPS funds across the Midlands. The company has been set up in order to meet the government's objectives to pool assets by the 1st of April 2018. And a lot of work has been undertaken over the last 18 months to meet this deadline. Jason will cover in more detail the background to the government's pooling agenda and the progress made to date. With regards to the issues to be addressed by the fund over the next 6 to 12 months, we will continue to work closely with LGPS Central in order to prepare for the transition of assets which is due to commence on the 1st of April 2018. Just to make it clear that individual pension fund benefits will not be affected by these changes, and Shropshire Council will continue to be the administrative authority for the Shropshire County Pension Fund, and the Pensions Committee will still be responsible for asset allocation decisions. In addition to this, we are currently reviewing our current asset allocation with the Pensions Committee, Aon Hewitt and our independent advisor. As mentioned previously, as the funding level has improved since the last valuation, we will continue to work with the committee in order to review the current investment strategy to make sure that the current level of exposure to equities in particular is appropriate, or if this should be reduced, another asset class is considered to reduce the risk within the fund. Although the equity protection strategy has been implemented, this is only a short-term decision whilst the overall investment strategy is being reviewed. This gives us more time to review in detail the long-term strategic asset allocation of the fund. Once the asset allocation review has been finalised, we'll be working with our investment consultant, Pensions Committee and the LGPS Central to implement the necessary changes to the investment strategy. Finally, to sum up with regards to investments, the fund has increased by 274 million last year and outperformed its benchmark by 4.9%. Since the end of the year, the fund has continued to rise and is currently at £1.87 billion. Longer-term performance of the fund over the last 3, 5 and 10 years is also very positive. We will continue to review our investment strategy in order to ensure that the current asset allocation is appropriate following the recent improvement in the funding level. I'll now hand over to Daniel Nicholas from Harris Associates, who actively manage an 8% allocation of the fund in global equities. Daniel will provide an overview of their investment style and their performance over the last 12 months, which was very positive, and also provide details of their performance over the longer term. Following Daniel's presentation, Jason Fletcher, the Chief Investment Officer at LGPS Central, will update you on the significant progress being made over the last 12 months to set up a £40 billion FCA-regulated investment management company. Thank you.
Good morning. Thanks for the warm welcome. My heritage is English, Scottish, and Welsh, like a lot of Americans, kind of a mutt, but I do feel very at home, so thank you for your welcome. And it's an absolute pleasure to be here today with my colleague Will Fox Robinson there, and we're honored to be able to speak to you. We're fortunate to come to you at a time where global equities have done very well. That's not always the case. We certainly don't like to lead with performance. We like to speak to our process because there are going to be dark times, and we want to make sure that you have conviction in us that we're good stewards of your capital. So today we come to you with good performance, but my approach will be to get you an understanding of our firm and then also provide you some ammunition from the leading academics on how should you invest your global equities. That will also help you read through some of the headlines that you're seeing in the newspapers. That will help you kind of dispel some of those headlines. Should you choose an active manager for us to manage your retirement on your behalf? Or should you just choose a computer because it's just too difficult these days to invest? So what we do for you, as Justin had mentioned, is that we pick the best portfolio companies across the world, not only in the UK, in the US, Asia. And what we do is we go and meet with management teams and we look in their eyes. We have them close their presentation book and we say, is this a quality business that we want to invest in with a management team that's going to protect our money and grow it over time? And all we do then is pick the 40 best stocks across the whole world. If you pick the computer, you would get 1,600 companies. And so we think that we can add value. We think we have a skill in looking in the eyes of these companies to determine if this is a good place to put your money. So that's what we do. We also do it in a value style, and I think all of us were brought up to know what value is, right? It's, if you're going out to get a loaf of bread, there's a certain price that you think that's worth. Why would you pay a lot for that loaf of bread? And that's what we're doing for stocks. But we're taking a different approach. We're looking at valuing the loaf of bread, not the price that the merchants are paying for that loaf of bread. We're just valuing that company, not the stock price. So I'll walk through that here for you today. We're proud to say that we're at our 4-year anniversary as of September 30th of being your fiduciary. So we thank you very much for having patience in our investment style. Because what you're going to see is we don't look like the benchmark, which is what we agree. You need to judge us in our performance in some way. But with only 40 stocks, we look significantly different than the benchmark. So our returns are going to look different. But we're thankful that since inception, we've been able to also outperform the benchmark over time. But as Justin mentioned, in 2014, when you first engaged us, the market wasn't looking very favorable to us. We were underperforming, but we've made our way back. And so now I'm proud to be able to say we had strong 1-year returns. And that leads to good returns over 5 years. And that's what we hope to be judged on, not 1 quarter or 5 months, 5 years. This is our strategy, but it looks like a lot of words on the screen. We really are just one philosophy, value philosophy. And then Justin and team can choose, do they want us to invest UK or US or non-US or put it all together in global. So we're not do everything for everyone like a lot of asset managers are. We know we're best at buying companies in equities. We don't invest in bonds and derivatives and things like that. Stick to our knitting. This is your team. We really believe in our team. I was just with a pension fund in Canada, and they said, we're going to keep you as our sub-manager, but we're also going to build our own team. We're going to try to do what you do and emulate that. And you could see their body language do this after we talked to them about our team and how special our team is. It's not that you can hire very smart people with a lot of experience. They must also know how to maximize the strengths and weaknesses. The team works together, and that's really the benefit, the culture that we bring to investing. We know that someone's good at modeling businesses, but we also know someone's very good at interrogating management teams. Let's put them together, and that'll get us a better outcome. So what you have here are analysts that come to Harris Associates. They could run their own business. They could be at hedge funds. One of them was working for Warren Buffett at Geico. Went and ran his own hedge fund, gave that up to come to work at Harris Associates because we have this great culture of challenging one another, building one another's knowledge, and getting good outcomes. Everyone, basically we do have some accolades though. David Harrow in the upper right, your portfolio manager, is the portfolio manager of the year according to Morningstar. He was the portfolio manager of the decade from 2000 to 2009. So we do have those stars, but we're not a star culture. We have our analysts come up with ideas, and then we approve the ideas as a team, and we can only build our portfolios from what the whole group decided. This is where we get in and get a little punchy, so I was hoping to keep your attention today. We're going to talk about global equities overall. And part of global equities, as Justin showed, was that there's a 50-50 mix between active investing and passive investing, which I would call the computer. And I had the opportunity to speak in New York in front of all the journalists, and basically they asked me to speak on active versus passive. And I said, it's great to be here. I don't believe I'll be here next year because I just received a call from my grandmother who said, "Are you okay?" And I said, "Why would you ask if I'm okay? I'm great, I'm in New York." And she said, "Well, I just read a headline that said active management is dead." And I said, "No, grandmother, we'll be okay, we'll be okay." And Jason Zweig was in the audience sitting right over there and said, "You misquoted me. You misquoted me." I said, "Well, isn't that ironic that I misquoted the press?" He said, "No," I said, "The business is dying, and not that you're dead." I said, "Well, it kind of felt that way." And so I said, "Well, can I present to you an argument of what leading academics are saying about the business?" And so this is what we discussed. Because I'm Welsh descent, English descent, I was doing a little research and said, all right, normally it's this battle of active versus passive, and we would think of a boxing ring, something like that. Well, who are some of the better leaders of their time in the UK? And I thought of Excalibur and King Arthur, and so I thought, let's depict that as the battle. And I would say King Arthur is active, of course, he's going to be my good guy. And the villain is Mordred. Now, we know what happened ultimately, unfortunately, between the two as far as life and death, but I would say that Mordred is the person who wants to be King Arthur. He wants to be active. He wants to get the will of the people. He wants to lead, but he doesn't have the attributes that Arthur had to lead. That's what we're going to call closet indexers. These are investors that are giving you a product that looks like the computer, but charging you a higher price. They're not giving you value for what they're giving. And so we're going to call that closet. And so it's true that the average active manager underperforms, but it's because of the Mordreds of the world, the closet indexers in the middle, that are making the results on average look bad. So truly active would be a 90% active share or higher, and Mordred's going to be 60%, that closet indexer. But you notice the number of holdings, Mordred's going to give you much more holdings. Say there's 500 names in the S&P 500, basically 200 names. It looks pretty close to an index, yet it's charging the same cost for that. And we don't think that's justifiable because net of fees, they're destined to underperform. And you should be choosing a manager that can outperform for you. So here's that average stat that you see in the newspapers all the time that Jason Zweig was talking about. The average manager underperforms net of fees. But you can see one bar is above the line. There's an actual cohort of active managers that justify their fees. It's just the Mordreds in the middle that are dragging down the results. And so what we want to do is we want to find managers that look different than the benchmark. So why would these managers be closet indexers? It's because there's a lack of indexing. So what you can see in the middle is the United Kingdom, but let's go on the far side. Here's Canada. In green, the amount of active closet indexing is the highest. The gray is truly active, and the middle is indexing. They have pretty much the least amount of indexing out there, so the active managers can get away with it. They don't have to be truly active. They can just kind of be in the middle, protect their assets, look like the benchmark, and charge you a high fee. The United States has the most indexing, and so there's more truly active management there and less closet indexing going on. So I would say that in the first slide I showed you Mordred and Arthur, they're sparring partners. Passive makes active activate. It actually makes active better. So it's not active versus passive, it should be active plus passive. So I was pleased the next week after I spoke with Mr. Zweig that this was his blog. Is your portfolio manager hiding in the closet? So I think I got my point across, that it's not active versus passive, it's are you getting what you're bargaining for? Is your manager truly active or not? Why would a manager be in the closet? Well, they want to protect their jobs. They want to protect their assets. If you underperform the benchmark, you're going to come up for review. You're going to look bad. and you may lose those assets, which in turn may cause you to lose your job. So what has happened is people said, I'm going to look more like the benchmark, because if I look more like the benchmark, I won't deviate from the benchmark very much. But what we've just shown is that if you don't deviate from the benchmark, you're destined to underperform net of fees. So what you can see with assets, what has happened over time, on the left-hand side, this is basically the percentage of assets invested in the most competitive market, US mutual funds. Let's go to the toughest market and let's study if anyone's been able to outperform in the US market. And then the colored boxes are going to show you what the active share is. So the top there is going to be the most active managers. There's about 10% of assets that are run by a 90% or higher active share. What you can see though, in the 90s, when the stock market was giving you a 30% return or so, many managers said, I'm not going to be active, I'm just going to join the crowd. If you can't beat it, join it, and I'm going to look more like the index. So the rise of closet indexing went up in the 90s. What's actually happened is that as indexing has increased, it's fighting the closet indexers. It's getting rid of them. And so you can see assets have come down over time of closet indexing. That's good for you. That's good results for investors. But what you can see on the top is that it hasn't really hurt truly active managers. We still run about 10% of assets. Not everyone has the heart or the time to invest with active managers, but if you do, it results in good outperformance. So active share is a stat. You can game the system. You and I can go out and build a portfolio that looks different than the benchmark. That's very easy to do. But that is not indicative of consistent, persistent outperformance. So what you see here is that Michael Mauboussin, who's an author that I really like, wrote a book, Untangling Luck and Skill. Tries to give us some guidance on how can you find a skillful manager. And he says active share is a good start. Don't go by the Morningstar rating, however. That is not predictive of future outperformance. What you want to do is get where our target is up in the upper right-hand corner. You want to find managers that are skillful that will outperform over time. So that's the next part of our discussion. How are we going to get to the upper right-hand corner of the box? What you need to do is have high active share managers. They look different than the benchmark, that are patient. They hold their stocks at least 2 years on average. I worked on Wall Street for 15 years. That's probably a bad thing to bring up, I would say. At least that's the way I look at it. And we had a 12-month target for a stock. If a stock didn't have a catalyst within 12 months, we'd put it aside and go look for another idea. People are very short-term oriented. People want things now. And we have an edge as active managers to look longer and say, you know what, there's a new manager at this business. They're going to turn around operations. If we give them time, it'll work. So what you need to do is not only have high active share, but basically hold stocks a long time period. High active share and turning your portfolio too fast destroys value. So if you were to look at the two high active share cohorts of all managers in the US equity market, you can see that only the high active share patient managers outperform over time the last 30 years. But only 1.6% of assets are run this way. If it's so conclusive, why doesn't everyone do it? It's really hard to be patient. It's really hard to not look at your statement every quarter and say, why is this manager not outperforming? But Justin's found a really unique cohort of global equity managers that do this for you. So what I'm saying here is that there is a fighting chance that woman and man can beat machine. So there is a fighting chance there. I'm thankful to see this from Barron's. So what you have is about a 50-50 mix between passive investing and active investing, and that's the best of both worlds. When I speak to the biggest sovereign wealth funds of the world, that's what they're doing. They're basically making sure that you stay invested in your stocks. You're going to get consistent investment at a low price, and then we're going to add in an active manager that can reactivate your opportunity to beat the benchmark and grow your capital over time. So we actually would say, that's what you want. You want this combination, and that's what you have. Okay, now how would you choose within global equities or any other asset class if you go to the computer or you go to us? Well, it's quite easy. If you go to the computer, we would say if there's a strategy that can be done by the computer, go there. It's cheaper, it's more efficient, you're going to get what you want. So think back in the 80s, we used to go to a supercomputer and give it the whole stock market. And it would spit out a screen for us to say, here's the stock market and here's the cheapest companies. And we could basically take that information and trade on it, and it was very helpful. Today, you can use a computer to do that in 1 second. There's no edge in running a screen. So if your manager is simply using a computer to find value, you should put that into an index fund. Use the computer to do that. But you have to find managers that think about creating value in a different way, that meet the management teams, that engage with the management teams, that can find hidden assets that the market doesn't know about yet. What I would say, though, is you should find managers that have these 3 key characteristics. So Martin Kremers is the inventor of active share, and he also has written additional work to basically say there's 3 pillars of active management. Number 1, of course, they must have skill. Our skill is picking stocks. Number 2, you must have conviction in how you build a portfolio. And number 3, the pensioners must give you the opportunity for that strategy to work over time. Patience. So what's perfect skill? So now we're going to continue on our metaphor with King Arthur. If King Arthur was an investor, he would probably turn to Merlin, his prophet, to basically say, what stock should I pick? And Merlin would have perfect skill. So there's a study that we found that basically said, since 1926, if Merlin had a stock portfolio and had the opportunity to get the best portfolio that will outperform over the next 5 years, he did very well. So think of 1926, you could buy a portfolio of the best performers, hold it until 1931. 1931, get the best performers until 1936. And keep doing that over and over and over. That's perfect skill. That would give you a 30% return, basically, if you were looking at the S&P market. Really good at consistent returns. The S&P only did a third of that. Now, it would come at a higher risk. That being said, King Arthur would be fired by you, and Merlin would be fired by you. Because look at these regal purple drawdowns. Even though they had the best portfolio over the next 5 years, there was a time where those stocks didn't do very well. And as a person, we don't like to have any downside. We don't like that risk. So we probably would have dropped them and sold them, even though it was the best portfolio during those times. Now, Merlin outperformed the S&P in all of these time periods, yet it's just an absolute loss that would have been very hard to hold on to. So I guess I bring this up just to say that even perfect skill will have some volatility in returns, but that's okay if you give it patience. Now, if you looked at Merlin's returns, you can desegregate what drove this. Sometimes we know small cap companies do well. That would be called size over there. Sometimes we know high dividend yielding companies do well, which happened in 2014 and 15 and 16. But we know over time that if you look at risk for the return you take, value is the basically criteria that has outperformed over the last 40 years. So we take a value approach. We think that'll work over the long term. Buy that bread at the right price, and then patiently wait for that bread to appreciate. I know that's probably a bad example because it's going to depreciate pretty quick as it goes stale. The problem is that value has underperformed the last 10 years. So if you went to the computer and said, give me value, because that's going to be the best way to outperform. I don't need an active manager to do that. I'm just going to take the value factor. You would underperform the last 10 years. So it's not as simple as picking one of these factors. You want to find an active manager that can give you the best recipe for outperforming of all these factors. So yes, computers can give you each one of these, or you can just get the index, which will give you all of this. But if you want to outperform, you need some skill to pick what's going to work. So at Harris Associates, we are known as a value firm. And what you could see slide up on the slide real quickly was that Morningstar would say we're a blend firm. And we just don't think that's accurate. We find value in the United Kingdom in all of these buckets. And these buckets are called large cap, so these are the biggest companies, or small cap, these are the newer companies. And then you have value, blend, and growth. And we don't look at value based on the way that people define it. We think every business must grow. If it doesn't grow, it's a value trap. It's just what price do you pay for growth? Is it a momentum stock? You're willing to pay a high price for the growth because you think it'll endure? That's great, that's one way to do it. Or you pay a low price for growth. That's how we do it. But what I wanted to show you is in the UK, we actually have on our approval list, we click all these buckets. We can find value anywhere. What we do is a little bit different than what the market does. We define value in 3 ways. Every company we buy must fit these 3 buckets. First, I would say it's high quality. So is this a business that's growing? And this is our green line, that's our estimate of intrinsic value. Secondly, is the management aligned with us? Do they own their stock? Are they going to protect us as minority shareholders? Are they going to do the right thing to grow that line? And lastly, it's price. If we've identified good businesses, then we only buy them if they're trading cheaply. So we're only going to buy them at a 30% discount. Now, we would say that maybe sometimes we'll be early. If we buy a stock that should be worth £1 at 70 pence, and all of a sudden it goes to 50 pence, should we just sell it because we were wrong? In our opinion, as long as the business is growing, a 50 pence pound is cheaper, it's less risky. Over the last 3 years, the stable stocks that had high dividends were trading at £1.20 on the pound. We think that's more risky to invest in the stable companies than the 50 pence on the pound. But it's going to make your returns look a little more volatile in the near term. But that's just the way that we find value. We compare it to what the business is worth and then let the stock market lead us to where the biggest discounts to value are, irregardless of what bucket that company may be characterized in. Is it a growth company? Is it a value company? So now let's look at momentum versus value. Perfect example is Tesla versus BMW. BMW was just in the Times 2 days ago. Oh, they have to invest in electrification. Their diesel business is in tatters. But Tesla comes out and says, we have to actually make our parts by hand, and we're not able to meet our orders. It's just a totally different story, but Tesla's stock will go up on that news, and BMW's will go down. Tesla is in orange here. You can see their ROE, they're losing 23% return on every dollar they invest, 10% margins negative, and negative $3 in earnings per share. But they have the same market cap as BMW. And so we basically say you need to find out the fundamentals of the business, figure out if the growth is justifiable in the price, and then choose to buy it or not. We choose not to buy Tesla, we choose to buy a BMW. BMW makes 2.4 million cars at a 10% plus margin. Tesla makes 74,000 cars at a negative 10 margin. These are 2 of our top returning stocks and bottom returning stocks from the last year. So I wanted to just show you a good and a bad. Glencore is on the good side, and GE is on the bad side. So I just thought I'd show our process with a good and a bad. So first let's start with GE. This is another academic book. It came from William Thorndike called The Outsiders. These are 8 unconventional CEOs that they highlight. The most conventional CEO of all time might be Jack Welch. He's known as one of the best CEOs ever. And he did well. He tripled the return of the S&P over the 20 years. He was very good at being an efficient operator. We never owned the stock for 30 years because he wasn't not only an efficient operator, but he failed at being a good capital allocator, and we need to have both of those. We saw a gentleman named John Malone, who we still invest with today at a company, TCI, got a 40 times return during that same time period because he was good at doing both. Capital allocation to us is they have 5 choices to use your free cash flow. If they can earn a return, they should invest in the business, they should buy other businesses, or buy back debt. If those don't earn a return, they should give us back the capital. Don't destroy value. Increase the dividend, buy back stock. You need to maximize those things for us to invest with you. So basically, GE meets our criteria today because their capital allocation is good. They brought in a new CFO. Instead of selling at the bottom, buying at the top, they're doing the opposite. They're buying energy assets at the bottom, in our opinion, and they're selling GE Financial, which got a very good price at the top. Here's Glencore. This was very controversial. What you can see are copper prices. I could put any commodity up there. 2015, China was slowing down their growth. No one wanted any commodities. And you can see that the prices were down. But what we look for are resilient businesses. Look at the free cash flow per share generation. Even as commodities went down 100%, they had an increase in free cash flow generation. So yes, the headlines are negative at times. That causes stock prices to decline. But we look at business value. And that leads us to where we should invest. So basically, all three boxes are ticked. I'm mindful of time, so I'm just going to go through this quickly, but happy to stay after and walk you through the details. So what do you have for your portfolio? Is it a Mordred portfolio or is it a King Arthur portfolio? 40 stocks. We want our top names to have a lot in the portfolio, so it'll be at least a third of the portfolio. We have a 5-year horizon, and then we also manage your risk. So here's your portfolio as of March 31st, 43% in the top 10, and we've held these names on average 6 years. And we own about 39 names. We think it's an attractive portfolio. It has a 16% growth rate. Remember, we're value managers, but we only have to pay 11 times cash flow for that business. That's an average multiple for an above average growth rate. We think that's value. Our approach on a bottom-up basis will lead to looking different than the benchmark. So just a quick example, this is Japan. And what have we done in your portfolio over time in Japan? Right now, the dark green on the far right would show that we're underweight Japan. That's weird because the market headlines are so positive. They're changing their focus on shareholder returns. Economic growth is turning from deflation to inflation. Should be a good time to find value in Japan, when in fact we are not. We found it in 2011 when we were in the earthquake. We had managers there hiding under tables. We had just met with the management. The market went down 18% in a week. The business value doesn't move as much. That leads us to go invest in Japan. So you can see that we had 400 basis points more exposure in Japan at that point. Where are we today? Where do we find value? We are putting your money to work here in Europe and in the UK. We bought more after the UK referendum. We met with all our management teams. We said, how's it going to impact their business? Many of them didn't know, but we took our best guess. We also put in the worst case scenario for Mr. Carney as far as what Brexit may mean for the operations. The United States, we're underweight. That's been a market that's had very good returns, but the discounts to value aren't quite as high, so we'd rather put it in Europe. What type of businesses do we own? We think financials are not as risky as people think. What happened with regulation? They had to raise their capital levels. It made their balance sheets less ominous. Much better way to invest, in our opinion. Consumer discretionary, the autos are not going out of business, in our opinion. They actually may lead this technological change. But the average business is worth 11 times. We only want to pay about 8 times for that business, and they're trading at 4 times. So we think a lot of risks are priced into these companies. We like consumer discretionary as such. After the global recession, we've had an overweight there. One company that we've been selling is Kering, which is the luxury goods Gucci. There's been a change. They're really marketing to the millennials very well. The change in the business over the last 12 years paid off, but it took us time for us to get the stock price to increase. What are we buying instead? Sir Martin at WPP. You can see the growth in per share value. You can see the increased dividends. You can see the increased buybacks. We think he's a value creator. So I'll just leave it at that. Basically, the takeaway is that I hope that you understand that our approach is justifiable. It's a long-term approach to really get to know these businesses. Sometimes the returns will look different than the benchmark. There's a piece from the London School of Economics called The Curse of Benchmarks. And they said, if your value managers underperform, you should give them a high five. That means they're sticking to their process. Now, it doesn't feel good to give a high five when returns are bad. That may happen from time to time, but please reach out to us, reach out to Justin and say what's going on. We're very happy to communicate with you that we're sticking to our philosophy and that with time we think we'll get paid for that. So thank you for your time. I appreciate the audience, and I'll be around for any questions.
Good morning. It's still the morning just. I was expected to be after, so we're ahead of schedule. So, I'm Jason Fletcher. I'm the new CIO for LGPS Central. I started a month and a half ago, and I've come from a background of working for the last year for West Midlands Pension Fund, which is one of the other pool members. Spent much of that time actually working for the pool, building the regulatory business plan, which we're going to talk about later. Prior to that, I've spent 20 years working for USS, which is a large pension fund for university lecturers. And I was actually an asset manager working at the coalface, very much like Daniel here. So that's my background. So what am I going to talk about? I'm going to spend about 20 minutes, so hopefully we'll be even further ahead of time and closer to lunch. I'm going to talk about what the plans are for LGPS Central, but I wanted to focus in particular on building an investment team, which really is, I think, my top priority, and also to emphasise a lot of the time on how this affects Shropshire, because that's more important to you. So why are we doing this? Essentially, pooling was thought up by government, and essentially it's been made. They put it in place because they wanted to generate savings and investment management fees without compromising performance. So essentially what they're after is they want lower investment costs, they want to improve your returns, they want to improve your governance, and they also want you to invest more in infrastructure, which we'll come to later again. And the overarching thing is that they want better governance. And that really, the direction we've been given by government is that means having better regulation, and that means getting your investment managers regulated by the FCA. So LGPS Central is being designed to deliver, most importantly, about 248 million of investment cost savings over the next 16 years. That is a very conservative number. Again, we'll come to how we can potentially do much better than that, even though it's a large amount of money. It's also looking to set up a dedicated and effective in-house investment option for shareholders. And then finally, coming back to a robust governance and assurance by setting up as an FCA regulated entity. So what is LGPS Central? We're the red bit in the middle. It's 9 pension funds, all of which are in the Midlands area, and to be honest, we're all quite like-minded. We've spent a lot of time together with 9 funds, and I think we've hit it off really well. It's been a really good exercise, and I think actually combining as a pool is something that's had many more benefits than just putting the assets together. I think we've had a lot of learning and people have got together. And I think we've found that actually we all want very similar things. And obviously one of those things is lower investment costs, which we could look to deliver. LGPS Central has been set up to manage those investment assets and will be regulated by the FCA. The other aspect to it, which is the makeup of the company, is actually on an equal weighted basis, which is interesting, especially from Shropshire's point of view, because you were a £1.8 billion fund, as Justin went to earlier, which is actually, I think, the smallest one in that group. But you have the same, or you as shareholders have the same rights as West Midlands Pension Fund, which has 15 billion of assets. But that was the way the company was set up, because we wanted to make sure it was fairly set between those 9 local funds. One other thing I'd just point out on this, because we've got to have a chance to be you might notice that we are the most concentrated. A lot of the others are very spread out, and I do think this is a key advantage in that we are all close together, we all speak the same language, and we are like-minded. So the regulatory business plan. This is a plan that needs to be written to get our FCA regulation. It sets out the objectives of LGPS Central and the key principles as to how the company will operate. Now, in sum, it's 60 pages, and it outlines what the investment offering is and what we're going to provide to you, the people and governance that's going to be set up. We're going to introduce far more risk management. At the moment, sometimes risk management tends to be left aside, focused very much on returns and not about the risks that's being taken. There'll be more of a focus there. The regulatory business plan also has at its core the financial plan, which is the cost savings, and also the regulatory capital, which we'll come on to later. So, how's the government put us in this position? What did they want? At the very start, they said we wanted pooled assets of 25 billion assets or more. We have now over 40 billion of assets between the 9 funds, so we've got a tick on this one. They wanted strong governance and decision making. Now, we are, as you'll see later, we're setting up all kinds of governance around at every level as well, so at shareholder level, at the board level of LGPS Central, and also having a regulatory background to it as well in seeking that approval. So I think we're moving in the right direction now. They want us to reduce costs and provide excellent value for money. Again, we've already highlighted what the cost saves are. We think we can do better, and we also want to be able to focus on actually improving your risk-adjusted return after costs, which is actually the real return that you get, which is what's really important in terms of trying to meet your funding ratios, which pleased to say Shropshire seems to have done a very good job. So, and then finally, this investing in infrastructure. Now, I think the government obviously has some interest in pension fund money being invested in infrastructure. I would like to expand this out, though, to actually really about how pooling can actually mean that smaller pension funds like yourselves have access to more investment opportunities, not just infrastructure. Infrastructure maybe, and I believe is, a very good asset class to actually meet your liabilities. But there are others as well, and I don't think we should restrict ourselves to just being infrastructure. We need to look elsewhere. So I do think all in all, I think we are trying to deliver on these, and certainly the government seems very happy with our plans so far. So, progress to date. I'm sorry, I can't read this, so I'm going to have to guess at what's been said on this. But this all started back in 2016 when we had our submission to DCLG, and we've been working through this up to where we are today. I think the key element will be this point here, where we actually submitted our application for the FCA approval, which is an absolutely critical part of what we're doing. Now, where we've got to now, the key thing right now is actually hiring staff. Sorry, just coming back to here, we started by hiring myself and also the board, and we're going to see some lovely pictures of us all later on. So that was the first thing. At this point, we're now hiring staff to actually manage the assets in April of next year when we go live. Furthering the submissions to the for application, and we're testing all the systems and things to make sure everything's in place for when we go live, which is right way along here at the end. The key date here is getting our FCA approval. Now, you will notice that we targeted this to ensure that we are ready by April go live date. So hopefully we're giving ourselves some scope to actually make sure that we can deliver on that time. So going forward, what do we do next? FCA application by December, testing all the systems. This includes testing all the risk systems, testing the IT systems, and also making sure we know what assets we've got, because we're looking at pooling 9 different pension funds, all with, in many cases, hundreds of different assets, where we've got to actually put that together and actually package it up as a full portfolio. We need to build the investment team, which I'm going to be in charge of, but also the infrastructure that goes around it. That's the risk management, that's the compliance, it's the legal work. There's plenty of roles which are not investment facing. And we're calling this as a whole infrastructure, but I see this as supporting the investment team in actually delivering returns to you. So go live in April 2018. And we will hope to actually initially launch soft funds at that point. And we will start with index funds and passive funds, but very quickly that will, in equities, but that will very quickly start launching into global equity managers, where we will be looking for internal and external global equity offerings. And then we will also launch bond portfolios or bond sub-funds over the next year. Then a year and 18 months ahead, we'll then be looking at launching the other funds, the more difficult assets to actually set up as a pool thing, so it's property, infrastructure and private equity. But I think what we learned from doing equities and bonds in that first year, I think will put us in a really good position for setting those pools up later. So coming on to the assets, or the offering, essentially what we want to do is make sure that we offer the most efficient structures, and also offer you the capability to invest in different asset classes, across different styles, and across different geographies. Now we've highlighted a number of structures which has been done: an ACS contractual scheme, limited partnerships, and also life policies. The key thing is to make sure that we put them into a structure that can be pooled, because it's going to be 9 funds assets all coming together, and it needs to be the most tax efficient and the most efficient, because there's costs to all of these structures, the most efficient system for investing. The other key thing is to make sure that you get that flexibility, that you can enact your asset allocation, which is going to be set by your pensions committee. So we're trying to structure it around that. And the key thing about this in terms of this offering, and I've only given you a small number here because initially we actually had over 40 assets, and again you wouldn't be able to see it because it's on such a big picture. But at the moment we have got 40, it is being reduced, number of sort of sub-funds, which will give you that flexibility. At the moment I think you have 15 different asset classes in terms of yeah. So we are offering at the moment a much larger group of asset classes, but through all these different approaches. A key thing on this though is that we need to offer the investments that allow you to enact your investment strategy. And as Justin said earlier, investment strategy, or picking the asset classes, is actually where the most value is added. It's the most important thing that you do. LGPS Central's role is to make sure that that's invested. We implement that for you. But I do hope over time, as we build an investment team, so we're looking to build a 40-person investment team in the West Midlands, I would hope that in time that team will be able to offer your pension fund and the other pension funds advice, similar to the way that Aon and your consultants work now. But I do think it's a really useful resource that can help you in making that really important decision as to which asset classes you're in. So moving on to the shareholder arrangements, I have to say my eyes glaze over when I see too many boxes and too many committees. This is having worked with the local council for the last year. It's a new thing to me. Hopefully a lot of this will actually be something you're used to or you've seen before, but it's essentially the governance around that sits above your investments. And a lot of these things you'll have now. The key thing is that we're now putting in LGPS Central, and they are going to be managing your assets, the investments here. But otherwise, not an awful lot is changing. So moving down another layer, we've got more governance, and this is actually at the LGPS Central level. We've got a board which consists of independent trustees who are specialists in the different fields of investments, of compliance and finance. And then under that board we have a series of independent committees who will all focus on the most important things in terms of running a private company. But these people, you've got to remember, are working for you. They're there to protect your investments. So moving on to the actual operating company. So we've got the board sitting at the top and the independent committees, and then we're going to have an executive committee. We love the word committees, we've got to get rid of it. I want to put something else in there, but that's what we've got. And then the company is going to be separated into 4 different parts. So the core is obviously the investments, I put it on the right, but that is the core of what we do. And the key things there are going to be fund management, and that's going to be investing money directly, but also selecting external managers, like Harris and other people who I'm sure that you've met. We will also be involved in implementation of strategy and offering new products. So when the next infrastructure comes along, we should be there to actually offer that, whether it be liability-driven investment or whatever else we want to invest in. And we also offer responsible investment. Again, this is something I think that's going to be really critical to local funds, is that we make sure that we integrate responsible investment into the investment department. I think that's just one of the things that will differentiate us from others, is typically your responsible investment will be included in another department. I want it full and central in the investment process because it's a really important part of the investment process. I did promise you some pretty faces, and I'm sorry about the cheeky grin that you've got from one in the middle there. But this is the non-executive, is the board, and you'll notice that 3 of them are non-executives, which is, again, comes back to the corporate governance. When we invest in companies, we expect them to have proper corporate governance. We have to have it too. So we've got 3 independent people sitting on the board. The 2 non-independents, the executives, Andrew and John, are working with me and the investment team. I'm not on the board. I spend most of my time reporting to it, but that's, again, it's important. I think the board needs to be independent. So moving forward from all these pretty faces, we've got, we're now in the process of hiring. I'm looking at getting, in fact, we've started advertising this morning on 7 different investment directors, so we're beginning to set up an investment plan. We've also got some key staff to work on the infrastructure side, the governance side. That's the Chief Risk and Compliance Officer and Legal Counsel. These are roles that we're looking to hire very soon. And then in addition, we've got 25 staff who are working for the existing funds, who will either hire to roles working in LGPS Central between now and April, or will transfer across in April 2018. So together, we're looking to build an investment team of about 40 staff, based in the Midlands, across Matlock and Wolverhampton, and we are going to be here to deliver your investments. I mentioned risk management, and I think this is one of the things that we are adding in, and it's extra layers of governance and protection for you as investors. And essentially what we're trying to do, and this will be the role of the Chief Risk and Compliance Officer when they're hired, is to make sure that we have a strict system for actually how we manage risks. Now, risk is a really interesting thing when you put it into a company structure, because it means different things to different departments. Within the investment department, risk is something that you have to take risks to get your return because of that link. It's really a case of making sure you know those risks and you make sure that you are getting the return for taking them. Now, in other areas like legal and compliance, there's no tolerance for risk. You can't afford for things to go wrong. So what we need to do is to have a risk management structure which separates all these different parts out. So we've got and they need to be independent. So the first line of defence against all those risks is essentially the investment teams, or as we see them as the poachers. These are the people you need to be careful of, which is why they're only in the first line. But their role is to try and make sure they manage risk properly. The second line is independent, completely separate from them. These are the gamekeepers, and that's the compliance, risk management, legal and operations and finance. And then the third line is your internal audit. Now, I would add another one to this, which is actually regulation. We will have the FCA looking over us to make sure things are being done properly. We will also have a depository, which is connected to our asset servicer, who again, they are responsible to make sure that things are being managed properly and your assets are safe. So I think this is a really important factor in terms of when we move forward into LGPS Central. Very quickly, just want to give an example of the processes we'll be using at the moment, which is really a group of risk registers, and then we identify a risk. So for example, if we were going to look at a building burning down, the risk of a building burning down, identify the risks, so try and see what your risks are. You measure it, so what's the probability of it happening, and how much it's going to cost if it does happen. Then you control and you mitigate that risk. That means setting sprinkler systems, buying insurance, that's the way you do it. And then you escalate and test. You check whether your sprinklers work on a regular basis. And you need to test your insurance. Make sure you get your insurance done at the end of the year, make sure you're covered. So I'm using it as a simple example, but every risk, whether it be an investment risk or whatever, we need to take this sort of approach, and that's the way it will be done. Now I want to move on to outsourcing. Now, I've talked great guns about getting investment managers in and doing lots of things in-house. The reality is we can't do everything. We will rely on external or outsourced services, for example, like external managers who are in specialist areas. That's not something we're going to be able to do from Wolverhampton and Matlock. So, though I'm keen to have things in-house, there are things we can't do in-house. Typically, the sorts of things that we want to do, well, first of all, we need to identify a role, which is what we're doing at the moment. We identify what needs to be done, and then we need to decide whether it can be done in-house and whether that is our best option. Now, we highlighted that some parts of investment management, finance, responsible investment, and risk management are all things that should be critically managed internally. We then need to identify where we're going to have gaps, what can't be done, and this is where we look to outsource. Now, this is where specialist investment managers, asset servicing, depository services, audit are all things that we can't do in-house. We do need to make sure we get the best outside provider. Now, so how do we get to those outside providers? We have a proper, open, fair and transparent procurement process. And that's something we've been doing at the moment. We're going through an asset servicer, depository, IT systems, and we're going through a proper procurement which is open and fair to make sure that we're getting the best value for money for you as shareholders. Once we've selected a manager using that full and fair process, we then can't just sit back and hope everything goes all right. We've got to make sure they're doing it properly. So be rest assured that whenever we are outsourcing a function, there will be someone at LGPS Central whose role it is to make sure that it's being done properly and will monitor to make sure that it's being done properly. So overall, I think what we're hoping to deliver is actually the best of both worlds. We will do things internally where that delivers the best value for money, and we will deliver things externally when that's where we get the best value for money. And we will make sure that proper governance is done over when things are done externally. Responsibility will still lie with LGPS Central, we know that. So, briefly moving on to the financial plan. This is really, for any new company, you need to have a financial plan. And it needs to be a sustainable one. We can't go and set something up here which falls over in 2 years' time. We need to make sure that it is ongoing and here for the long term, because your liabilities are for 30 years plus, and we need to be around in 30 years' time. The financial plan is planning, I think, very conservatively to deliver £248 million of savings. A lot of money over 16 years, but I think we can do much better together, and I'm confident how we can do that. And just at this point, mention that £36 million of that will go to Shropshire, just from those very conservative numbers. The other thing, which is a new thing we're going to have to look at, because we're all used to working in local government, is actually as a private company you have to have regulatory capital, and also to be a member of to be authorised by the FCA. This does mean that some capital needs to be set up, which is part of the original shareholder agreement. This is actually to protect the firm and to make sure that it's properly regulated and is needed by all private companies. And is absolutely critical to making sure we're a sustainable business. All of this has been put into our financial plan and is with the FCA application, which we do hope is actually going to work well. This business and financial plan has been developed together with partner funds and also advised by PwC and Eversheds. And all the partner funds have actually put a lot of time and effort into actually developing this. And I'd like to thank all of them, Justin included, for all the efforts they've had to put in this company together. So, onto the Shropshire bit, the stuff that should be interesting. As said earlier, the key thing, or first thing, is we are looking to lower your investment costs. We've highlighted in the business model that we think there's a £36 million cost saving. The other thing that I'm very committed to is that we will have full cost transparency. So we are going to be very open about where costs are charged. If there's any costs that have been put in, we will make sure that it is fully transparent to the shareholders. The other thing on costs that's absolutely critical is that moving from managing money of 1.8 billion to 40 billion gives you huge economies of scale. And I think that's something that's critical to making you get those cost savings going forward. The other cost saving potentially could come from internal asset management. Internal asset management is cheaper. The key thing is they've got to prove they're better than external managers to actually improve their case. Now, obviously, they've got lower costs, which is a good start, but we've got to prove that we can deliver as well as Daniel or other external managers. No, it's a tall order, but I do think it's an option that we need to consider. If we've got 40 investment staff, we should be offering some investment services in-house because it's cheaper and they're also completely dedicated to working for the pool. They're not working for other managers. This point I wanted to also remind you of what Justin said earlier. Key thing in all of this is pensions are still provided in the same way. There is no change. Your pension will still be provided by Shropshire County Council. So in sum, LGPS Central is going to reduce your investment costs. These cost saves are conservative. We think we can do much better and we'll work with you to try and deliver more cost saves. So the second area of benefit is that ability to invest in more areas, your greater investment capability. The key thing here is that ability to improve your risk-adjusted return after costs. The key things there are risk-adjusted, you've got to measure your risk, your return, you need to know what your return is, and costs. They're all equally important, and they've all got to be measured, analysed, and reported on. So that's our standard tag as to what we're trying to do, and the key thing in that is getting you value for money, improving your returns. We're going to offer more asset classes, styles and strategies, which should open you up to having a bigger box of tricks to invest in to try and deliver your strategy. And we'll also offer a dedicated local investment team. LGPS Central really should improve your investment capability, and that's top of my mind. So, moving on to greater governance. We are putting in some extra layers of governance, and this will cost more money, but I think it is worthy. We have had lots of cases of local government funds, thankfully not in our area, where governance has not been good enough and it has led to poor returns. So I think it's really something that needs to be bulked up. So the first thing is being FCA regulated. It gives you an assurance that things are being managed properly. So absolutely critical. We also have a depository which is connected to our asset servicer, but again, they are also another pair of eyes to make sure things are being done properly for you. We have dedicated oversight internally, the risk management that we've been talking about, another layer of trying to. The other thing is we will improve the monitoring of the assets and actually the selection of assets, and I think that's something that we really can deliver on. All of this is to protect your interests, and that's the key thing. Your interests are the thing that's most close to our hearts. That's what we want to sort out. So, moving on to how we do better. We're taking a series of different ways that you can different ways you can reduce your investment cost. One of them is fund of funds. Now, I'm not sure how much you've got, but there are cases of platforms that sit between Justin and the underlying fund managers. What we want to do is to cut out those platforms in terms of the middlemen, because they're all taking fees. So moving from funds of funds in alternatives is actually 2 layers of funds of fees compounded on it. If we can move that to doing more direct investments and co-investments in alternatives, that will really reduce your costs. Still give you exposure to high return and good asset protection investments. But that will be positive. Pooled investments, moving to segregated mandates. Pooled investments, again, it's more of a middleman. They're providing full services. And typically, you give them the money, they go away, they invest it, and they report back. With segregated mandates, you have far more control over what is invested in, and also it allows you to actually have control over engaging with companies who are responsible investment. So there's an advantage in terms of better control by being segregated mandates. The other funny thing is when money's just taken away and invested for you, and you don't have it segregated, it tends to be more expensive. And it's because typically pooled investments is something that's aimed at retail investors. Segregated is actually at institutional investors. And this is really about, do you want to be treated like a man on the street, or should you be treated like a 2 billion or a 40 billion investment manager? You want to be treated like an institution. Property. Indirect property is, again, there is lots of middlemen taking, and women taking money away from you through this process. The more direct you do, the more of those fees you're taking out. And this is a lot of money. So the more we can invest directly in property, we can reduce our investment costs. Key thing is we make sure that we get just as good investments, and that's the critical factor in this. And I think this is most highlighted by this thing here, the active versus passive. Daniel put a beautiful case for active, and I'm a full believer, I'm with you all the way. The key thing, though, is passive is cheaper, but is it as good? Will you get as good returns? So we could actually put all your assets into passive and we'll reduce your investment cost to almost nothing. Active is more expensive, but you will get a better return from it if you pick the right managers, if you pick someone who does a good job. Now, you've got to balance up at this point. Are you getting an excess return that beats that to make it worthwhile? Because you will pay more fees here. Now, I'm a big believer in active. I do think it's worth trying. I hate this idea of just handing something to a computer. I think you've got to have a try. The other thing I love about active is if you have active portfolios, you engage directly with the companies, make them better. And I think that's critical. Responsible investment is an important way of doing that. And then finally, this won't be a pleasing thing for Daniel here, but another way is actually to reduce your costs is to move from external management, which does tend to be more expensive, to internal management. Again, you've got to weigh up your investment returns. Is it worth your while? Anyway, there's a number of ways we can work together to actually make sure you lower your investment costs and, most critically, get your net return up. So I've gone way over 20 minutes, so I must apologise for that. But we have finally come to the summary. LGPS Central is here to deliver those cost saves. It's here to improve your investment returns. It's to offer you a dedicated, cost-effective, in-house option for your investments. And it's to offer robust governance assurance by setting up an FCA-regulated entity. LGPS Central will strive to offer superior risk-adjusted returns after costs to you, the shareholders. Thank you very much.
Good afternoon, everybody. It is afternoon now, so nice to see so many faces that I recognise, but actually also some that I don't. So welcome today to our presentations. I'm Debbie Sharp, and I'm the Pensions Administration Manager who looks after the team, and a lot of them are here today should you want to discuss anything, of actually paying your benefits. So we're here to ensure that what the pension fund is set up for then actually gets delivered. So we're collecting money, but then we're paying benefits out to our members. So at the end of the day, hopefully Justin, Jason, Daniel will be looking after the money, and you've got a guarantee you will get your benefit paid. Their job is to ensure it's cost less for the employers, so less for the taxpayer, and then my job is to make sure that you actually get an accurate benefit and we pay it on time to you. So how do we do that? What are we doing? What's actually keeping us busy? I think the government have started tinkering with Justin's domain in what they do and how they're investing the money, and that's now employing Jason. So, hi Jason, welcome to working for Shropshire. What are we doing in my team? Because they've been tinkering around with what we have to do for many, many years. I've been around in pensions too long. So back in 1997, we sort of started having a look at what would we have been doing. And actually, a lot of staff members, 20 odd years ago, might have been in local government for 40 years. It was an area of employment that was fairly static. So in those days, you had a fairly basic calculation. We used to have a pension at that point in time calculated, and then they'd have an automatic lump sum as well. No decisions to be made by that member. So you can see here, we chose sort of middle management salary back in 97, around about £15,000. They'd end up with a pension if they'd worked all those 40 years in local government there of around about £7,500. And they would have had no decision but to accept a lump sum of £22,500. The salary, you'll see there the pension sort of increased in today's value. If that person was still enjoying their retirement, their pension would have grown to just under £13,500. So the pension keeps a good value. It is increased with, used to be the retail price index, it's now the consumer prices index, but it's still indexed every year. The salary there would have, equivalent nowadays, is probably just under about 30,000. So you'll see it's sort of keeping value with middle management salary nowadays. Supposedly simplified calculations, and seemingly the membership stayed where they were, but that's partly to do with some of the changes that have been introduced over the last few years. You can see there back in 1972 was when the main changes happened to give widows benefits to the pension scheme. I haven't put all the legislative changes up because, of course, since then we've also had changes that now cover widowers' benefits, civil partners, and also cohabiting partners now. So we have the full gambit. But it was only back in 1972 that actually a full widow's pension started to be paid out. And that was because they improved the gentleman's lump sum. So up until that point in time, there was a short period where you could cover your wife to have a pension, but you had to give up part of your lump sum. So that was changed in 72. But changed quite a lot after that when widowers' benefits were brought in, and then only the last few years where we've actually had civil partners and cohabiting pensions introduced. But some of the biggest changes sort of happened in late 1980s and then in the 1990s, when actually the reason why we may have had more people just having 40 years in local government was because basically only full-time members were actually allowed in the scheme prior to the 80s and 90s. So part-timers were then allowed to join, and more staff were actually becoming part-time in those sort of decades. And you'll be interested to see that that's one of the big changes that actually did this to our membership. So over that 20 years, you'll see that our total membership has gone up by nearly 3 times. So back in 97, we had 16,000 members split over those groups. So you've got obviously active, somebody who's working and currently contributing. What a deferred member is, or a frozen refund, is somebody who's left the scheme, no longer is contributing, but we still have a benefit or a value of money held for them. And then, of course, retired members or survivors' benefits. But we've now got just under 47,000 members in our fund. We're not we're a medium-sized fund. You've got the big Mets or the big counties that are bigger than us, but our membership too, you can see there how much it's evolved just over those 20 years. What's also changed is employers in the pension fund. We have 3 areas that you actually have employers that are allowed in the pension fund across Shropshire. Everyone is based, or their employees are based in Shropshire. You've got scheduled employers there, the county councils, the unitary councils, academies. I'll touch on academies a bit in a minute, but you've got certain categories of employers who have no option other than to make sure that their employees come into our scheme. So they've got a good protection there for those employees. Designated employers in the middle, some people in the room might have been employed by the town and parish councils. So town and parish councils have had the option for many years to choose the local government pension scheme if they want. They don't have to, they can choose it. And also now we've got other employers like Star Housing, so wholly owned companies perhaps of the county council that are slightly now separate, aren't directly the county council, but the county council has an interest in them. They can also choose to use us as their pension scheme if they want to. And then we've got the other set of bodies which have dealt with outsourcing. So when a service gets outsourced, the employees do have a protection if they've been in the local government pension scheme, perhaps working for one of the main councils. And so we have lots of other companies now. So we've just put a couple up there. You'll see Veolia. So a lot of the waste collection. We've got coverage care. So we've got a lot of the care providers, the staff that have transferred over and have been in our pension scheme as well. And so you'll see there, we've had lots of changes over the last 20 years as well. It started mainly Telford and Wrekin becoming a unitary council. 2000 was when the outsourcing regulations were sort of finalised, and it was in sort of law then basically that if you have a private contractor taking over a contract for a council, the employees were protected. 2009, doesn't seem that long ago to me, but Shropshire Council became, Shropshire Council actually started when Shropshire County Council merged with the districts and the boroughs from around here. 2010, you just did mention the increase in your employers as well. You can see there in 1997 we had 56. That's now 164. 2010, schools could actually start to become academies. What that means is up until that point in time, a school was part of the local authority. We had one employer then, the local authority. Each school that becomes an academy is an employer in their own right, so we have to deal with them directly. So that just creates more work for us, but also more work for the schools. Things that they never actually realised were being done for them by the council came out of the woodwork. And they then went, oh, we really have to do this? Yes, you do. And then the other thing that's actually happened, auto-enrolment. You will have seen lots on the TV over the last few years about I'm in and all about auto-enrolment, the Draggers Den people walking down the street. Well, auto-enrolment has meant that we've had more members because more people are being put in automatically by their employers if they've chosen to opt out previously. But what's also happened is, as well as the academies, auto-enrolment, more town and parish councils have actually come to us and said, we want you to be our main provider as well. So we're getting more employers from different routes. The other things that you might not realise actually affects your benefits with us, is what the government decides to do with the state pension as well. So anybody who's a retired member in the audience and who is already receiving their state pension will have seen that when you get your increases each year, actually your increase from the local government pension scheme, if you were in contracted out employment, you pay less national insurance, that actually part of your increase comes from the state on your benefit from us. So it just complicates the calculation, but overall you get the right increase. But last year, then, contracting out was ceased by the government, so that affected current employees who were still active members of the scheme, had to pay more national insurance from their wages. Employers had to pay more national insurance, they no longer got the contracted out rebate. But what it also meant then is that the government decided that they would start looking at how were they doing this increase. Because of their introduction of the new single state pension. They were trying to simplify what they're paying, and what's happened is that actually this interaction between the local government and the pension scheme is now having to be looked at because the government's decided the complications between them increasing part of the pension, us increasing part of the pension, they don't want to do it anymore. That has two effects for us. It changes what we have to do, but also it costs us more. If they decide that we've got to increase that amount of pension now, then the pension fund, so the money we're investing, some of that will be needed to be used to pay more benefits than we thought it would in the future. But what it does mean is that it gives my team a big exercise, because the government's computer systems have obviously changed over the years. They almost didn't have a computer system to begin with back in the late 70s. And we've got to actually make sure that our records match what they think our records should say. So all of this contracted out employment, where they think we've got a liability to guarantee a benefit, and we've got to make sure that we agree and we think we have. If we don't do that, they may be making us pay pensions that we don't think we need to, and that will cost the fund more as well. So a big change for us at the moment in actually trying to make sure our records match theirs. There'll be discrepancies on both sides, but it's actually identifying those discrepancies and sorting them out. And the other thing that changes nowadays, any changes to the state pension age affects our benefits. So for current members, every time the state retirement age changes, then our benefit becomes payable from that date as well. So that's for current employees, not anybody who's already finished. Another area that the government likes to change is how they decide whether you need to pay any additional tax on your pension other than just income tax. So back in 2006, they called A Day, which was a day that simplified pensions and tax, apparently. We didn't believe it at the time, and it's just sort of come to fruition that actually it didn't simplify it, but hey, we work with it. You'll see here, back in 2006, when they made the changes, they decided how we deemed whether there was any additional tax to be paid on a pension. They just said anybody's pension, no matter where you work, you can have a pension pot worth up to £1.5 million. If your pension pot at retirement is more than that, then you're going to need to pay a bit of additional tax. But since then, it started increasing, so they gave us a bit more, and they said, oh, you can have a bigger pot through to 2010-11 there. 11-12 stayed the same. They were obviously starting to think then, not quite sure whether this is working for the Treasury. Actually, let's start going the other way, because we want to actually collect some revenue, basically, from pensions. We've allowed people to have too big a pot, apparently, and so they started reversing it down the other way until you can see in 2016, 17 year, so last year in April ago, it's been reduced right down to £1 million. Doesn't affect a lot of people. It affects my team, because for every single pension we have to calculate what someone's lifetime allowance value is, and anybody who actually goes over the 1 million, then of course then we've got to work with them to make sure that they pay the right tax on it. But that is your value, because your pension isn't usually a total value. You don't have a pot, you have a defined benefit scheme. Your benefit has been based on your service and your pay. So the revenue give us factors that how we calculate that value to your pension. And basically, to get £1 million pension pot, you will need an annual pension of 50,000. So, that would be nice if we all did have one of those, but it's getting close that each time they're bringing that figure down, more people are getting caught into the pensions that we do actually find that are going to be affected by the tax. What they also introduced at the same time was an annual allowance, which is how much your pension can grow in a year. And that's a bit more complicated for a defined benefit scheme like ours, because we don't have a pot. You have a defined benefit. So actually, how much is that increasing in a year? So again, we have factors given to us by the revenue that how we can calculate this. But you'll see there, back in when they simplified the rules, you could actually have growth in 1 year of 215,000 into your pension pot. That's what they decided seemed fair in those days. You'll see there, it started to grow again. They'd allow you to put in a bit more, but 2011-12 actually decided they weren't, whatever their decision to come up with the other figures, it wasn't working for them, and they slashed it dramatically. You'll see there that now 50,000 became the limit that anybody could actually have growth in their pension. And that's now been reduced down to 40,000, a bit of a glitch in 2015-16 because they changed the actual period we have to assess a pension over. But now it's 40,000, but last year they also brought in a different reduction that anybody who's a higher earner can have that 40,000 annual limit reduced down to 10,000 depending on their earnings. And again, £40,000 growth in a year only means someone's pension has to have increased by £2,500 in a year, because the factor they used, that would give you a growth of 40,000. We're having far more of our pensioners now, our active members, may fall into this category because somebody who has a promotion, who's got quite a few years in final salary benefits still, finds that they're actually exceeding this growth. So there's a lot more people that it is affecting us now that we have to keep them aware of these figures. This one just demonstrates that, of course, we've had another key changes. They keep changing the accrual rate and tinkering around with our benefits. So we're now having to calculate, somebody who's been in the pension scheme for a few years may have 3 different parts of the benefit that we have to calculate for them. So we just have to keep a track of what their service is, and now what their final pay is for anybody who was in the scheme more than before 2014, but also now benefits are based on care. I'm not going to go into the calculations around that because we've covered it before, but it's just knowing that record keeping is very important nowadays because we have to know how to calculate the benefit correctly. So what have we been doing? What actually my team does over the year is, these are a couple of figures. We like figures, we like statistics, so you can just see here what happens nowadays. Over those 140 odd employers, then over the last year, we were notified of just under 4,000 people that actually were new starters into our pension scheme. So we have to create, records and start keeping their records up to date. Just over 2,000 people left the scheme but didn't draw a benefit straight away, so you'll see their deferred beneficiaries. So just some numbers there to know what we're dealing with. You might be interested, more people, you can see there, more people leave without a benefit, over 2,000 against the actual retirements of just over 700 people. So, we still are having retirements, they're not stopping. People are working longer, but lots of different things there. 629 people opted out. Auto-enrolment rules now mean that every 3 years those people are brought back in by their employer and given another choice. Well, did you make a good decision there? But just some statistics for you, just interesting to see what numbers of cases we're dealing with, as well as having to do what we do in a nutshell. Pay your benefits, pay them on time. Issue annual benefit statements to all our active members, issue retired members your pensions increase statements. We have to increase your benefits each year, the same as the deferred members. They have to have a benefit statement to tell them what their benefit is increased to. But all of the bits that also go behind the scenes there about collecting the money, doing all of our returns to the HMRC, ensuring we're keeping up with those annual allowance checks, the lifetime allowance checks for our employees, the governance. Jason mentioned a lot about governance on the pooling. Governance has been ramped up in even administration. We've now got the pensions regulator who ensures that we're actually compliant with their codes of practice. So lots of different things to do. Those 140 odd employers need to be trained and kept up to date with what they have to do. We just collect a lot of the information. Remember, they've got to actually collect it in the first place from their employees, so we work very closely with the employers to make sure they know what to send us. So as I started with, never a dull moment. That's me done.